Crypto regulations are changing faster than most investors can keep up with. While everyone's focused on price action, they're completely missing the regulatory shifts that will determine whether you can keep your crypto well or whether the government takes a massive chunk of it. Here's what you need to understand. The USA passed the Genius Act for stablecoins. We've talked about this in other videos. The SEC is finally providing clarity on what's a security, and we're heading into 2026 with the clearest regulatory framework crypto has ever had. I'm going to walk you through where crypto regulations stand as we enter 2026, what's coming next year, and how to position yourself to thrive in this new environment. John with Numeratus, we're a white glove accounting firm specializing in crypto compliance. Everything you can imagine a big firm doesn't want to touch. Complex crypto portfolios, international crypto holdings, business structuring for crypto operations. That's what we do. We've been tracking crypto regulations through Bitcoin's entire journey over the past 5 years. We've helped over a dozen clients navigate regulatory changes, stay compliant, and optimize their crypto operations as laws evolve. Brings us to point number 1, the 2026 regulatory landscape, where we actually stand. Let me cut through the noise and tell you where things stand as we enter 2026. Over the past 5 years, Bitcoin went from $10,000 to peaking above $100,000. That's a 10x increase. But what most people don't realize is that this appreciation happened alongside the most significant regulatory transformation in crypto history. And 2026 is when everything comes together. The Genius Act passed July 2025. Congress passed comprehensive stablecoin regulation. The Guiding and Establishing National Innovation for U.S. Stablecoins Act creates federal guardrails for stablecoins like USDC and USDT Tether. Key provisions: stablecoin issuers must maintain one-to-one reserves with high-quality liquid assets, public disclosure requirements for government officials holding stablecoins, and treasury oversight of suspicious transactions. This matters because stablecoins processed $9 trillion in adjusted payments over the past year, more than half of Visa's payment volume. Now they have clear federal regulation going into 2026. SEC's clarity revolution. Under Chairman Paul Atkins, the SEC completely reversed its regulation by enforcement approach. They're now providing actual clarity instead of just suing companies. The SEC published statements clarifying that meme coins are not securities. Certain proof of work mining activities don't involve securities. Certain stablecoins aren't securities, and certain protocol staking activities don't involve securities. This is the clarity the industry has been begging for. When we have the generic listing standards, this happened in September 2025. The SEC approved generic listing standards for commodity-based trust shares, including crypto ETPs. Exchanges can now list crypto ETFs without filing individual 19B forms for each one. This cleared the way for the flood of institutional money that's been flowing into crypto. The CFTC's Crypto Sprint. The CFTC launched a crypto sprint to enable trading of digital assets at the federal level. They're working on allowing spot crypto contracts on CFTC registered future exchanges and exploring tokenized collateral in derivative markets. For example, an investor entering 2026 has access to regulated Bitcoin and Ethereum ETFs, can use stablecoins with clear federal oversight, and knows that certain crypto activities like staking and mining aren't considered securities offerings. This is a completely different regulatory environment than even 12 months ago. Point number 2, the debanking problem and how it's being fixed. One of the biggest regulatory issues in 2024 through 2025 was debanking. Banks refusing to serve crypto businesses because regulators were pressuring them. This is now being addressed, and it's opening the entire traditional banking system to crypto. In 2025, the Fed officially ended the practice of using reputational risk in its supervisory program. This is what the subjective standard that enabled examiners to pressure banks away from crypto clients. Federal Reserve Vice Chair Michelle Baumann testified in December 2025 that banking supervisors should never and will not, under my watch, dictate which individuals and lawful businesses a bank is permitted to serve. The Fed is now considering formal regulation to prevent board personnel from encouraging banks to debank customers based on political or religious beliefs or lawful business activities. The FDIC and OCC actions. The FDIC rescinded its 2022 prior notice requirement in March 2025, clarifying that banks can engage in permissible crypto activities without seeking agency permission first. The OCC affirmed in March 2025 that banks can engage in crypto custody, stablecoin activities, and participation in distributed ledger networks. There was an executive order in August 2025. President Trump issued Executive Order 14331, guaranteeing fair banking for all Americans, which directed bank regulators to identify and stop unlawful debanking practices. The OCC published bulletins in September 2025 aimed at eliminating unlawful debanking in the federal banking system. For example, a crypto business that was rejected by multiple banks in 2024 could now get banking services in 2025 and 2026 because regulators stopped pressuring banks to avoid crypto clients. This opens up the entire traditional banking system to crypto businesses, which is massive for industry growth. This brings us to point number 3, the 2026 tax enforcement reality. The IRS has all of our data. Many investors are sitting on significant gains from crypto's multi-year run, and the IRS knows about every single one of them. Here's why. There's the broker reporting, which will take full effect in 2026. Crypto exchanges are now required to report cost basis information to the IRS on Form 1099-B, just like stockbrokers. This started in 2025 and will be in full effect for 2026 tax returns. This means the IRS will know exactly what you paid for crypto and what you sold it for. No more forgetting to report gains. This means increased enforcement. The IRS hired thousands of new agents specifically for crypto enforcement. They're using blockchain analytic companies to track transactions. International tax treaties are forcing foreign exchanges to share U.S. customer data. This will bring us to the enforcement wave. Many investors made significant gains during crypto's multi-year bull run. If they didn't report those gains properly, 2026 is when the IRS will come calling. For example, an investor who bought Bitcoin years ago and sold during the bull run realized substantial gains. They didn't report it. The IRS now has comprehensive data from exchanges showing the transaction. In 2026, we'll get an audit notice. We'll owe the taxes plus penalties, 20 to 75% of what they actually owed originally, plus interest, compounding daily since the transaction. A tax bill from 2021 could easily be double or triple by 2026 with penalties and interest. The time to get compliant is now, before the 2026 enforcement wave hits. By the way, we talk about crypto compliance, strategies, and how to handle unreported gains in our Q&As in our private community at Numeratus.org. If you want to get ahead of the IRS enforcement, that's where we break down exactly what to do. But let's get back into it. Brings us to point number 4, the international context. The USA versus the world in 2026. Crypto's growth over the past 5 years wasn't just a US phenomenon. It's global. And understanding international regulations gives you context for where the USA is heading in 2026. And we have such things as the European Union and the MiCA implementation. The EU's markets and crypto assets, MiCA, regulation is now being implemented across all member states. This creates a unified regulatory framework that many expect will influence global standards. The United Kingdom has the Transatlantic Task Force. The United Kingdom's His Majesty's Treasury and the U.S. Treasury announced the Transatlantic Task Force for Markets of the Future to facilitate cross-border digital asset regulation. They're expected to issue recommendations around March 2026. The United Kingdom also created a third category of property specifically for digital assets, recognizing that crypto is fundamentally different from traditional property. And these regulations go to other countries as well. Singapore continues to have clear licensing requirements for crypto businesses. Many international crypto companies operate there for regulatory clarity. El Salvador still has Bitcoin as legal tender. Their Bitcoin holdings have appreciated significantly over the past few years. China maintains its ban on crypto trading and mining, missing out on the entire crypto bull run. The USA is positioning itself as the global leader in crypto regulation. I'll say that again. The USA is positioning itself as the global leader in crypto regulation. Not as restrictive as China, not as experimental as El Salvador, but creating comprehensive regulation that enables innovation while protecting investors. And what does this mean for you entering in 2026? If you're a US-based crypto investor, you're operating in one of the clearest and most favorable regulatory environments crypto has ever had. The rules are finally written. Institutional money is flowing in, and the regulatory framework supports long-term growth. And this brings us to point number 5. What's coming in 2026? The next wave of regulations. Several major regulatory developments are coming in 2026 that will affect every crypto investor, such as the wash rule, where crypto is currently exempt from wash sale rules, but this loophole is closing. Expect Congress to address this in 2026. When this happens, you won't be able to sell crypto at a loss and immediately buy it back to harvest tax losses. This is a major tax strategy that will potentially disappear. If you're going to use this strategy, think about it before you do it in year-end 2025 or in early 2026. We have DeFi regulation. The SEC and CFTC announced in September 2025 that they're prepared to consider innovation exemptions for DeFi protocols. Expect these to be formalized in 2026. The Department of Justice clarified in August 2025 that developers of neutral tools with no criminal intent won't be prosecuted for unlicensed money transmission, but expect more comprehensive DeFi regulations in 2026. There's going to be expanded CFTC authority. The Senate Agriculture Committee released a bipartisan discussion draft in November 2025 that would give the CFTC exclusive jurisdiction over spot digital commodity markets. If passed in 2026, this would create clear regulatory authority for Bitcoin and other commodity-based cryptos. We will have stablecoin expansion. The Treasury of the United States of America issued an advance notice of proposed rulemaking in September 2025, seeking comment on implementing the Genius Act. Expect detailed stablecoin regulations throughout 2026. And we also have the CBDC development. The Federal Reserve continues researching a digital dollar. While implementation is years away, 2026 will see significant policy discussions about whether the United States should launch a CBDC. For example, an investor holding significant crypto positions in December 2025 should be thinking about 2026 tax implications, potential wash sale rule changes, and how new regulations might affect their holdings. The regulatory landscape is stabilizing, which is good for long-term holders, but you need to stay informed about these changes. Point number 6, how to position yourself in 2026. Here's how to position yourself to thrive in 2026 with clear regulations finally in place. Get compliant before 2026 tax season. You have unreported crypto gains from the past several years. Get compliant now. The IRS has comprehensive data from exchanges. Voluntary disclosure is always better than getting caught. Document everything for 2026. The 2026 tax year will be the first full year of broker reporting. Make sure your records match what exchanges report. Document your cost basis for all holdings. Use year-end tax strategies. The wash sale exemption still exists in December 2025. If you have losing positions, harvest those losses before year-end to offset gains. Consider whether to realize the gains of 2025 or defer 2026 based on your tax situation. Take advantage of clear regulations. Staking and mining are now clearly not security offerings. If you've been hesitant to stake, now is the time. Stablecoins have clear federal oversight. Use them with confidence. Structure for institutional level compliance. If your crypto holdings have appreciated significantly, consider proper entity structures, trusts, and wealth protection strategies. If you're running a crypto business, structure it correctly now that banking is available and regulations are clear. Plan for 2026 regulations. Expect wash sale rules to close. Plan accordingly. Expect DeFi regulations to clarify. If you're using DeFi, understand what's coming. Expect continued IRS enforcement. Stay compliant. For example, an investor with substantial crypto gains from the past years should be working with a tax strategist now to minimize their 2025 tax bill plan for 2026 regulations and ensure they're positioned correctly for whatever comes next. The regulatory transformation over the past 5 years enabled institutional adoption and market growth. The investors who thrive in 2026 will be those who understand both the opportunity and the regulatory requirements. Look, we're at a historic moment. The regulatory framework is finally clear, and 2026 is when everything comes together. The Genius Act passed, the SEC is providing clarity, debanking is starting to end, broker reporting is starting, institutional money is flowing in. This is the new era of crypto. This video showed you where regulations stand and where they're heading, the before and the after. The bridge to staying compliant and thriving in this new environment is where Numeratus comes in. If you want to stay informed about crypto regulatory changes, IRS enforcement actions, and compliance strategies as we go into 2026, join the Numeratus community at numeratus.org. For $100 a month, we track regulatory changes in real time and break down what they mean for you. We have conversations with experts in the field. If you need a more hands-on approach, if you have unreported gains from crypto's multi-year bull run, if you're running a crypto business that needs proper structuring, if you want professional guidance navigating the 2026 regulatory environment, book a consultation call at numeratus.us. We specialize in crypto compliance and regulatory navigation. That sounds interesting to you? Book a call.